Good evening. My name is Lori Kaplan. I'm board president of Ashland.news and very involved with our community outreach that we like to do for Ashland.news. This collaboration for the Better Prepared series started actually 3 years ago when we really started thinking about how the number one issue facing our all of us, our community, a universal concern is our risk of wildfire living in this beautiful place, which obviously many communities are facing all over the world and especially on the West Coast. But we really wanted to step out, see what we could do to be helpful, and partnering with the city has been really wonderful. And we're very pleased to bring you this program tonight. So I uh, tonight the format is going to be we have our guest speaker here tonight, Sharice Sidoriak, who's our community expert, is going to moderate the session. We will be taking questions throughout. There's a Q&A function on the bottom of your screen. I didn't see mine right away, so I'll tell you, if you don't see a little box that says Q&A with a question mark, uh, click on your button. There's a circle with three little dots on it on the bottom of your screen, and that should give you an option to show your Q&A. So maybe what y'all could do to give me some confidence that you're out there, you hear me, and you're able to use your Q&A function. If you could just say hello or something in there, and we'll know you're out there. All right, look at that. Thank you, guys. Wonderful. Thank you. Okay. And we will be monitoring the Q&A throughout, but we'll save the questions. We'll be kind of organizing them. My colleague Hillary Larson will be doing that, and along with Sharice. And we are very pleased to have two of our city folks with us from the Ashland Fire and Rescue, Brian Hendricks, our Fire Adapted Communities Coordinator, and Chris Chambers. And I can't remember, Chris, what your title is, but there they are. Wonderful. I am going to pass this to Sharice.
Can you hear me?
Yes.
Okay. Well, welcome everyone. Thank you for your interest in wildfire and insurance coverage. The topic is a very real conundrum for those of us who live in a wildfire-prone environment. The 2020 Almeida fire and current wildfires across Canada and the Western US are a painful reminder to prepare before danger is close to home. An important part of that preparation is having adequate insurance coverage. Before introducing our primary speaker, I'd like to acknowledge everyone affected by past and current wildfires and reflect on the dedication and sacrifices made by all who strive to protect communities before, during, and after a wildfire. Most recently, our thoughts turn to Spokane, Washington, where more than 900 homes were destroyed or heavily damaged in the first week of this month. Fortunately, there were no reported fatalities. But in Spokane, insurance claims are already substantial. By August 10th, State Farm alone reported receiving more than 550 home and auto claims, and the company expected that number to increase because some neighborhoods were still inaccessible. Washington's insurance commissioner quickly intervened, issuing an executive order intended to prevent people dealing with this disaster from immediately losing coverage because of payment or renewal issues. The Washington State Insurance Office is also holding monthly claim workshops for Spokane wildfire survivors. Oregon has a parallel insurance function in the Oregon Division of Financial Regulation. If there was a slide, I'd show you the full name of it, but Matt Ramage is the Consumer Education and Education Engagement Coordinator in that office. His job is to help Oregonians better understand insurance so they can make informed choices. Matt enthusiastically agreed to join us today and to share his knowledge about preparing for wildfire and other disasters from an insurance perspective. Matt will help us understand how to make sure we have the insurance protection we need before a wildfire and other types of natural disasters happen. As Lori pointed out, while he is speaking, please enter your insurance-related questions in the Q&A box. During the second half of today's webinar, Matt will answer the questions. and he may be assisted by 3 local experts. So take it away, Matt.
Thank you,
Oh,
Sharish.
one thing I wanted to insert is we will have a break for 5 minutes after Matt's presentation.
All right. Thank you very much, Sharice. I'm going to try and share my screen and hopefully everybody can see it. Yep, looks like it's sharing. Good deal. Okay, again, my name is Matt Ramage. I'm with Oregon's Division of Financial Regulation, and I'm going to dive right in. So here we go. DFR, Division of Financial Regulation, is part of DCBS, which is the Department of Consumer and Business Services. And it's got 5 divisions or 5 agencies within it. Building Codes Division, which helps establish standards for which buildings are constructed. OSHA for worker safety, our division, and then the 2 arms of the Workers' Compensation Division. DFR's mission, like Sharice spoke about, is about making sure that Oregonians have fair access to what we regulate. And we do that through education, regulation, and consumer assistance. I'll talk about that a little bit more. DFR's primary function is to make sure that the financial institutions that we as Oregonians all interact with are functioning within the statutes, and that Oregonians have access to resources to make sure that your rights are protected. This list isn't entirely comprehensive, but it's pretty close, and kind of from top to bottom: insurance. So insurance agents, insurance brokers, mortgage service and lenders, investment professionals. We have an amazing student loan ombuds program that'll help people navigate a crazy process that's going on within that industry right now. Anything in state chartered banks or credit unions, not federal lending institutions, but state. And then a whole host of consumer finance functions like check cashing and pawn shops and title loan lenders, money transmitters, things along those lines. All of those are regulated, and most people have no clue that DFR exists unless you happen to be someone who maybe was an insurance agent or works in financial services, or perhaps maybe had a complaint and you reached out. But for the most part, I bump into people who are like, who is DFR? That's what DFR is, and offer all sorts of services to help protect consumers. One of the most helpful things that we have within the agency is our consumer assistance or advocacy team. So you can reach out to this group at any time. What they offer are assistance with respect to general questions like, hey, I don't understand what's covered or not covered on my insurance, or I don't understand this financial contract that I got myself into. So simple stuff like that. It can be much more in-depth things where perhaps they are going to reach out on your behalf to your carrier or your financial provider and help you kind of move through what might be a log jam. In some instances, they might find that you've got maybe a more egregious situation and encourage you to file a complaint. And if a complaint is filed, it then goes into an investigation and potentially an enforcement role. What's really important is that, we are not here to put people out of business. We're here to make sure that those that are offering professional services are operating within the law and the statutes, and that people are being treated fairly. We helped almost 17,000 consumers in 2025, resolved over 5,600 complaints, but returned over $7 million to Oregonians. So, does that mean that everybody who makes a phone call to DFR is going to get a check? No. But if you feel like your rights have been violated, or you're confused by what's going on with one of your financial professionals you're dealing with, or you just kind of need help, it's fine to reach out. It's free services. Resources are there, and it's just information. So please give it a shot. There's an 800 number there. You can also go to the website, dfr.oregon.gov. All sorts of opportunities there. When I do things in person, I always bring printed materials. I don't have that opportunity today, so I would again encourage you to check out our website, which is dfr.oregon.gov. There'll also be some links offered at the end with some specific documents regarding disaster preparedness and things specific to wildfire. But there's a whole host of things that are available. This particular presentation is around disaster preparedness and wildfire in particular, and how insurance is a tool to help kind of navigate through that. Insurance is that. It's a financial tool to help protect you against the impact of a disaster. And a lot of folks think of it as, oh no, it helps protect my stuff and gets things replaced. Yeah, that's true. But it's also really at its core to help protect you against the financial losses and devastation of your home being, when it's burnt down, and the costs associated with that, or being houseless, or your car is destroyed, or you've caused injury to somebody. The insurance is there to give you that financial, protection. And in Oregon, you think about the types of catastrophes that we have that are likely to happen. Wind and rain, ice storms, pretty typical here. Of course, wildfire. We're in the midst of it. It's now the worst wildfire season on record from acreage burn. I think it's close to 2.4 plus million acres have now burned, and we got almost 2 months left in this wildfire season. Yuck. Flood is a very real risk, and we've had some pretty severe flood seasons recently. You don't have to be near a river or the ocean to be susceptible to flood damage, and earthquake. All of these things are things that can be mitigated through insurance, not eliminated, but mitigated and managed to an extent. And that's really what insurance is about having a plan. The day after something happens is not the day to check to make sure your coverage is right. That's just too late. And in the case of flood, you got to be planning well in advance, because a flood policy has to be issued at least 30 days in advance of its activation. So things to think about. Another major and important function that DFR has is, when we engage with consumers and communities, we get feedback on things that are a concern, and we also work with legislature to help move things through and provide feedback. There's been a lot of activity in Oregon regarding wildfire in particular, and here's a couple key things. I don't have Senate Bill 82 on here, but back in 2023, it passed, which established the need for insurance carriers to have consideration for home hardening and defensible space, and consideration is a key word. It wasn't a hard requirement that they had to take all efforts and directly apply that, but they had to consider that. So it was a step. It also prohibited the use of the state wildfire map, but established that it was going to be used. The wildfire hazard map was going to be used for the management of resources. Well, it set people off, of course, and the subsequent pushback led to Senate Bill 83 and the petition process that now has been repealed. And so what's happened is, yes, the wildfire hazard map is no longer allowed to be used for any planning purposes, and the home hardening codes and defensible space requirements that were statewide are now shelved. The sad truth is that the impact wasn't, I think, what people expected was, my insurance rates are going to go down, because the hazard map was never used for insurance rating anyway. In fact, it was prohibited to be used for insurance rates. And I've had this conversation with lots of folks, like, hey, did anybody have an insurance policy issued before 2020? And everybody goes, well, yeah, of course. I've had insurance in my home for 20 years. And the question I ask them then is, how do you think they rated that policy if they didn't have that hazard map? And they're like, oh, I never really thought about that. And the answer is, insurance companies have proprietary tools that they've had in place for years and years to do rating. And that hazard map was never part of the equation. Were there some companies that mistakenly referenced the hazard map when it came to renewals or non-renewals or rating? Absolutely. And that was a horrible thing that they were doing. But it wasn't being used to rate policies, and it created just massive customer confusion. So it created some issues. Senate Bill 85 came up. That was passed in 2025. It's a step in the right direction to establish a insurance industry level community-based wildfire mitigation standard. And once we get to that level, then homeowners can say, hey, I've met the standard, I can get certified, and now I can be assured I am accessible for insurance. The affordable aspect, that's a whole different conversation, but we're moving in the right direction with Senate Bill 85, but it's not a done deal yet. We still got a fairly long runway before that's going to be in place. House Bill 3940, allocated some money to help pay for wildfire prevention and mitigation and preparedness and response. This really was on the heels of the 2024 wildfire season, which was just horrific. And that was the previous record-setting year of 1.9 million acres having burned. The other key thing that took place was House Bill 2563 that made it a requirement for insurance carriers to provide clear explanations of premium increases and changes at renewal, because oftentimes people were getting notices that felt like gibberish or were legalese, and it wasn't fair to consumers. And so now you have a right as a consumer to say, hey, I need this clearly defined as to what's going on. And if you're not getting it, you should reach out to DFR and let us know what's going on. So we actively work with the industry, with legislature to try and make sure that consumers' needs are heard. One of the things that recently occurred, which maybe you've seen, is that an emergency order was issued at the end of July with respect to wildfires, and it put a moratorium on non-renewals for property policies for the next 30 days. And this was done, first it came out from the governor's office, and then it was followed up by a bulletin from the insurance commissioner saying, hey, here's the zip codes that are affected, that this moratorium is in place, meaning insurance companies cannot issue non-renewals for policies based on wildfire risk during this next 30 days. And then it's up for review at the end of August, and might be revised or extended. I'm not privy to how that's going to play out. That's the commissioner's decision, but it does not happen often. This is a pretty unique year because it's already been pretty devastating, and a lot's gone on there. This chart really illustrates a lot of what's happened over the past 40 years or so. In the 80s, 90s, 2000s and 2010s, what you're seeing is estimated actual insurance payouts in billions of dollars. And these are just blips. I mean, so a couple $100 million over the course of 40 years in just the state of Oregon is really nothing in insurance losses. And then all of a sudden, 2020 came around. And so from 2020 through 2024, we saw as a state nearly $3 billion in losses just associated with wildfire. And when you layer in winter storms and other wind events, now we're over $4 billion in a 4-year span. This is the crux of why insurance premiums have spiked, and why the insurance underwriting process has gotten so tight, is that payouts have gone outrageously high, and risk tolerance has come down. So and until the tide shifts and starts going the other direction, I think we're going to continue to see premiums be on the rise, and accessibility of insurance is going to continue to be a challenge. Doesn't mean we're not still working on it to try and resolve that, but this really is the issue. When payouts spiked, everybody in the state, doesn't matter if you're in Southern Oregon or in Joseph or in Eugene or LeGrand, anybody who's got a policy issued in the state, because of the way insurance works, we're all impacted by it. And if you're in a higher risk area, you're more impacted by it. When you're considering insurance at a property, there's things that you should absolutely be mindful of. And the first thing is really assessing and mitigating hazards where you live. And there's lots of good standards to think about with respect to defensible space. And I'm not here to endorse one over the other, but defensible space is real and it's effective, and it's going to help reduce risk of loss in your homes and your communities, and it's going to help you retain and secure insurance. All these things are very real. The challenge is that there is not a single standard that all insurers in Oregon are currently operating under. I wish I could say they were, but it's different. And so you might say, well, I'm with Allstate and they require me to do this, and but I'm with State Farm and they require me to do this. Absolutely possible. I can tell you my example personally. I own a secondary home in Central Oregon with a couple other families, and it's insured by a carrier. And they gave us a long list of things we had to do to renew. And I was thrilled, actually. I'm like, sweet, I'm going to get renewed, but I've got to do some home hardening things. So they recognized the value of the home hardening and the defensible space, and provided I did it and proved it, we got our policy issued. If I would have not done it, we would have lost our coverage. And so there's a step in the right direction that's occurring in the industry, but there's not pure alignment yet. And so it there are some problems here. Had Senate Bill 83 not come through, I think we would have had a better understanding across the state that all of the home hardening requirements would have been the same. But they're not quite there. So doing defensible space and creating home hardening or doing home hardening projects around your home are important, and in many cases are going to be required for you to maintain your insurance or get quotes if you're looking out for it. This is a image that's actually from a video that IBHS, Insurance for Business and Home Safety, did, and it was it's pretty well, it's obvious when you see the video, but it's two structures. One that's built with standard wood framing and wood shake siding wrapped in bark dust around the foundation, and the other side is a cement fiberboard with rock around the foundation. And then it's built in this massive warehouse, and they are blowing embers at it like a firestorm, like a wildfire. And what you see is that the house on the left, which is wrapped in wood and has bark dust around it, has caught on fire because the embers hit that structure, drop down, and ignite the bark dust. On the other side, the embers come down, hit the rock, and they die out. And so this is a really great example of home hardening and defensible space really working. The defensible space of rock around the foundation doesn't give embers a place to ignite, and that cement fiberboard does not burn very well. What you don't see at this house is any shrubbery around it. And if there were plants under the windows of either one of those homes, that'd be a problem, because if embers hit the plants under the cement fiberboard side, they could catch on fire and burn the window frames, and it could enter the house that way. So, that's why it's so important to have that defensible space around your home. And some insurers are going to have that requirement as well. And so very, very important to listen to them and try and meet those requirements. When you are evaluating your insurance and looking for coverage, it's important to ask questions. First off, if you don't understand everything, or you feel like you're being talked to too fast, like maybe I'm coming at you too fast, review the information, ask lots of questions. It's okay to ask questions. I mean, you're paying a premium. Your agent or your broker is making a commission. It's okay to ask. You want to be informed. You do at least want to make that review of your policy annually at your renewal time. And you want to make sure that you don't have inherent gaps. One of the biggest gaps that starts to happen is your coverage limit ends up being below what you need to actually replace your home or your possessions. And if that ends up happening and you have a catastrophic loss, the insurance company is not going to make up the difference. They're just going to say, well, you're underinsured, and then you're in trouble. So it is on us as individuals who own or hold the policy to make sure your coverage is adequate. Because you would think, my insurance company knows I've made changes. They know things happen. Not always. And if you've done a remodel or you've had a change in your risk at your home, you need to communicate that to make sure that you've got the right coverage in place. So when things happen, or you've added risk, or you've added on your home, or you've added to your family, communicate that, make the changes, and get the right coverage. Oregon is what's called a standard fire state, because well, let me back up here. DFR is the regulatory body of standard insurance companies or admitted insurance companies. And so there's multiple types of insurance that's available. You can get admitted or standard insurance, or non-admitted policies, also referred to as surplus lines. We at DFR regulate the standard policies, and most common home insurance policies are from standard carriers. And I'm not here to endorse any one of them, but all the national big brands are things you would recognize. Those are standard policies. A standard policy is going to cover typical perils like fire and weight of snow and ice and falling objects and theft and vandalism, power surges, and that kind of thing. A whole list of things that are standard. Fire is the first thing that's listed on every homeowner's policy, because Oregon is a standard fire state. Fire is covered. Wildfire, kitchen fire, electrical fire, chimney fire, they're all covered. What's super, super important is there's only one fire that's not covered, and that's going to be arson. If you light your house on fire intentionally, you need to know that you're not going to get your insurance policy to cover that. And I would also say, there's a doctrine that you need to be mindful of, which is insurance has this thing about sudden and accidental, which is things that happen suddenly and accidentally are generally going to be covered under insurance policy. So, a tree falls on your house, that's sudden and accidental. A pipe freezes and breaks, that's sudden and accidental. A water pipe that's leaking for months on end, and you find a soft spot, that's not sudden and accidental, and likely is not going to be covered unless you have specific coverage for that. So super important to be aware of what's covered and what's not. And if you don't understand your coverages, make sure you talk to your carrier about that. The things that are not covered, and these are big ones: earthquake and flood on a standard homeowner's policy, that stuff's not covered. Now, you might have coverage through your homeowner's policy as an endorsement. That's great. But a typical homeowner's policy as issued does not cover earthquake and flood. If you have flood insurance, you're going to have coverage for tsunami as well, because flood and tsunami would go together. But a homeowner's policy does not cover the earth or earth movement. So things like a landslide or sinkholes, your homeowner's policy simply does not cover any of that stuff. So if you have a home that's built on a cliff, or you have a hillside in the back that you're afraid might slough off and send debris down and hit your house, you would want to consider landslide coverage, and that's a pretty specific type of insurance. You want to look into that and be mindful of it. Flood insurance, and I came back to this again. You don't have to be near a source of water. You got to think about if water flows over the soil or collects in a low spot near my home, then you're going to have flood damage, and your homeowner's policy won't cover that. Flood damage also often follows wildfire, because if wildfire takes away the ground cover, now water more easily flows over the soil, and you can get water infiltrating into homes. So something to think about. If you're in a low flood risk area, flood insurance can be pretty inexpensive. If you're, happen to be where the floods happen a lot, it's more expensive. So I'm not telling you how to spend your money, but it's definitely worth checking out. Looking at your policies, on a declarations page, it's broken up into sections. The dwelling section is about, what it's going to take to replace your home. It's not the value of your home. It's not like, Zillow and Redfin say my home is worth $900,000. That's awesome. But what's it going to take to rebuild it? That's what you want to have it insured for. And there's lots of other additional types of optional coverages you can think about. I think one of the most important ones to consider is extended replacement cost. This is important when you consider a catastrophic loss. Let's say you have a home that's insured for $500,000, and that's the replacement cost estimate. So that those things line up perfectly. But you live in a neighborhood and 20 homes have been lost to wildfire. All of a sudden, material costs have spiked, labor costs have spiked, and it doesn't cost $500,000 to replace your home. It's now all of a sudden $600,000. Again, insurance doesn't adjust and go, we're going to pay $600,000 because costs went up. Nope. they're going to say your policy limit was 500. We're going to pay 500 less your deductible. You're in the hole. With extended replacement cost endorsement, it's set up as a percentage of the dwelling limit. So let's say 25%, 50%, or 100%. If you have a 25% extended replacement endorsement, that means you're going to have access up to $125,000 of additional funds if you have a catastrophic loss. But you're not paying for that $125,000 every day and every year for the premium. You're paying a very small percentage with that endorsement. So something to think about. You can ask for quotes for all of these sort of things. Doesn't cost anything for a quote, and then you can kind of gauge, is it worth it to get those sorts of protections? Another important one to look at is other structures, things that are not attached to your house. And a big one to think about is a garage. If your garage is not attached to your home by a wall or the roof, it's detached. And some garages are pretty snazzy. You've got it all fixed up inside. It's got a living space or a shop or maybe an ADU type setup. And it's maybe it's worth $200,000, or it's going to take that much to rebuild it. But your other structures limit is $40,000. Again, you've got a significant gap in your coverage, and you want to be aware of that and be mindful and make a change if you're worried about it. Contents, this is your stuff, your housewares, your furniture, your boots, your whatever you got, all your stuff. But a big thing to be mindful of is that there's going to be inherent limits and caps on certain categories, things like jewelry, collectible items, fine arts, firearms. All of those are going to have limits that are much lower than the listed personal property limit. So let's say your policy says, oh, my contents coverage limit is $250,000. Very well could be, but your limit on firearms might be $5,000. So if you've got a whole bunch of rifles because you're a hunter, or you've got a 6-carat diamond solitaire ring that's worth $60,000, you want to make sure that your policy accurately covers your items, or that you're comfortable with the gap in coverage. Additional living expenses, referred to as ALE, sometimes also called loss of use. This is going to cover your expenses if you're unable to live in your residence because it's damaged by a covered peril under your policy. As an example, tree falls on your house. You can't live in it because the roof is wide open and it's raining in your living room. It's getting repaired because it's insured, but in the meantime, you got to live in an apartment or a hotel. The funds under your insurance policy help cover that. And that often is the case, or sometimes it's because you've been evacuated and you can't be in your home for weeks on end because you've been evacuated. ALE would kick in there as well. But you want to understand that it's limited by time. Usually it's no less than 12 months you have access to tap into these funds, and then there's a dollar amount. The other thing is that it's for the additional expenses. It's not for your regular expenses. So it's not going to cover your regular rent or your regular mortgage payment. It's going to be the additional stuff. You got to still pay those regular monthly expenses. And then, if you have a new rent because you're living in an apartment for a while, that's going to come into play. The big difference between homeowners and renters insurance is that in a home, you're either own it or you're buying it. So you have an ownership interest in it. So you can insure the dwelling and the structures that are on that property, and then your personal property and liability and other things like additional living expenses and any other endorsement on there. And if you have that property is financed and you're working through a lender, they're going to require you to have insurance. So that'd be a homeowner's insurance. Under a renter's policy, you're not insuring the structure itself. You don't own it. You're not insuring that actual thing, whether it's an apartment or a rented house or rented condo. You're not insuring that structure. You're insuring your personal property liability, additional living expenses, and perhaps other endorsements like jewelry or things you might want to have other coverage for. Some landlords will require you to have renter's insurance, but not all of them. So things to be mindful of. It's a good idea, but you may not be required to have renter's insurance. It's super important to have an inventory. And to do this before you get like an evacuation notice. If you're taking an inventory with your camera phone on the way out the door, you're probably not getting the best quality stuff. So do it in advance. Take some decent photos and some slow video of each room, open doors, closet doors, and cupboards so you can see what's behind them. It's a great way for you to be able to go back after the fact and actually make a claim. You can also do it by writing a list or doing a spreadsheet. All those things work, but the visual of taking pictures or video often is one of the simplest ways to do it. There's apps you can use as well. They all work fine. It's really what's the best solution for you. But the big thing is, don't do it when you're stressed out and running out the door. We also offer resources for businesses, and we have some specific guides about general commercial liability and property insurance for nonprofits, for shelters, for childcare providers, and for restaurants. All those are available on the website at dfr.oregon.gov. And so they're important kind of general guides. But with respect to small business insurance, a lot of small businesses look, I'm just worried about general liability because that's the minimum requirement. Well, that may be true, but you overlook some other things that are pretty important. And so if you have a business and perhaps an agent that has kind of presented you an option, they may have presented you what's called a BOP or business operators policy. That's going to include a commercial liability or a GL policy, a commercial property insurance policy, and a business interruption insurance policy. That's kind of this core package of coverage that is pretty important for a small business. Then you get into another realm of things that become pretty important, which is workers' compensation. If you have employees, you need to have workers' compensation. If you have vehicles that are operated for the business, you need to have commercial auto insurance. And then some lesser thought of things like key person life insurance and cyber risk insurance. One of the things about liability insurance is that if you have a professional function like an engineer or an accountant, you're going to need some specific liability insurance for those professional functions. So you got to think about that. General liability is for the general function of the business. But business interruption is the one that I get the most questions about as it pertains to wildfire, because in many cases, communities have been impacted from the revenue standpoint of people evacuate or leave town because of smoke or fire risk, and businesses have a revenue impact because they simply lose traffic, and they think, well, that's business interruption. Well, yeah, the business has been interrupted, but the core idea of business interruption is that you have to have a physical loss for the property that's covered under the insurance policy for the business interruption coverage to kick in. So as an example, if the fire actually damages the building with which the business operates, then the business interruption coverage would be applicable. Now, there's some additional coverages or things that could be brought into the mix. Things like civil authority would be an interesting thing to consider with your coverage, which says if an evacuation is issued that forces the business to shut down, that civil authority then could trigger that portion of the policy, which would then give you coverage under your business interruption policy. It's important to know that if you have business interruption insurance, you have to have really detailed records, because you got to be able to show what was interrupted and what you're trying to recover through an insurance claim. You just can't say, oh, I need $30,000 in lost revenue. You're going to have you got to open the books and show those things. So you got to be super, super detailed. There's other layers of business interruption, like contingent business interruptions. Like if you have a supply chain that is reliant on a specific piece of material that's coming from across the country, and a hurricane occurs and you can't get that from anywhere else, that contingent business interruption would cover you for those types of losses. And then extended business interruption is there for when your business has been closed down and is opened back up and it's sort of ramping back up, but you're not up to full speed, and it sort of fills the gap between your regular revenue and profits, and kind of where you're at right now. Again, all of these things are optional types of coverage with a cost associated with them. So you need to have that conversation with your agent and see if it makes sense and if it's a value or not to you. Some folks are like, yeah, it all makes sense. I want to do that. I want to have the best coverage. And others are like, no, it's too much money. I can't say what's right for you, but it's important to have the conversation and ask for quotes. Workers' compensation, like I said, if you have employees, you got to have it. It helps protect them, helps protect you against lawsuits and penalties. So if you employ people, have workers' comp insurance. Oh, and I went too far. Commercial auto, if you're running a business and you've got commercial autos that you're running, you really don't want to be mixing personal auto and commercial auto. It's a mess. Can get you in all sorts of trouble when you go to file claims. It could also get policies canceled if you make a claim on your personal that happens to end up being a business claim, and it's just ugly. So you want to be forthright about what you're covering and what you're not covering. And you also want to be mindful that when you have a commercial auto policy, you're going to have to be very specific on who's operating the vehicles. So like what a very detailed, complete driver list of who's there is going to be required by most carriers. So be aware of that. Key person life insurance is really there to protect if someone has the secret sauce of your business and they were to pass away, that you have this protection, that you can have the financial fallback. It also could be used to potentially buy out maybe the heirs that might, that person may have transferred ownership to a family member. You could potentially use those funds to acquire that portion of the business, which is also important to think about for planning and succession. But a big thing to think about is there's gaps. There's gaps in all policies, but business policies have gaps for pollution and terrorism. Flooding, like I talked about, is not covered under a business policy. Earthquake, landslides, and disease. All of these things are not part of a standard business policy, but you can talk to your agent about what's called the difference in conditions to address these gaps if there's things you're worried about, or that you are exposed to those risks as part of your operation. Flood insurance for business is available through FEMA and the National Flood Insurance Program, just like it's available for residences. NFIP, or National Flood Insurance Program, is not a great policy. It's what's called an essential policy. It's there to give you sort of basic coverages. It offers contents and structure coverage at actual cash value, so it's depreciated, which is not ideal. And it has that 30-day waiting period to be activated. So you can really be mindful of, if you're going for flood insurance, that waiting period can bite people. Cancellation on any policy or non-renewal, claims frequency, claims severity, poor driving records, all of those are things that would come into play. Risk, as it pertains to wildfire and things, absolutely, those are factors that are going to be a consideration. Not necessarily, not the hazard map, but every year insurance companies look at their payouts, their policy holding position, and the projected payouts, and they either tighten their risk tolerance or they open it up. And so they, it's like up and down. And so they can adjust what was a attractive risk one year and say, no, we don't want it this next year. When I was an agent, it was kind of frustrating for me as well. The two main reasons why policies get canceled: first one's non-payment, pretty straightforward. The second one is misrepresentation. If a carrier finds out that like a home was listed as being 3,000 square feet and they come out and find out that it's 4,600 square feet, completely misrepresented, or that, hey, there's a swimming pool here and you didn't tell us there was a swimming pool. Those are things that are going to get people potentially canceled. DFR's function with respect to rates and working with insurance carriers is to review them every year annually when they're submitted by the carriers, because every year carriers have to go through a process of what's called a file and use. So they review that their payouts they've done in the previous year. They look at their policy holding position. They have a requirement to have a certain amount of cash on hand to protect their policies. And then they have to then say, well, do we have to adjust our rates up or down? I would love to say it's down, but it's been up for the past several years. And then they submit that to DFR. DFR then says, does it meet the statute of being excessive, inadequate, or unfairly discriminatory? If it is flagged for that, then they're going to get pushback to the carrier and say, no, you can't do that. So an example might be a carrier does the math and all the statistical analysis. It comes up with a base rate adjustment of 20%, but they say we're actually doing 30%. Well, that's excessive. You said it was 20, but you're taking 30. You can't do that. If they do the math and say we came up with 20%, but we're only going to do 10 because we're trying to grow our share, well, that's inadequate. You're not actually pulling in enough premium to protect your policyholders. That doesn't work either. The unfairly discriminatory is harder because each carrier applies their underwriting factors differently. I mean, they all kind of look at the same things, but they may weight them differently. And you've probably experienced this because maybe you've gone out to get quotes and be told by some carriers, nope, not going to issue a quote. And you get quotes from another company where it's like, yeah, we'll give you a quote and it's $5,000. And a competitor says, oh, we'll give you a quote for $2,800. And why is that? It's because they're weighting these factors at a different level and all sorts of things. But fundamentally, they're going to look at things like what's the replacement cost, the item that they're insuring, what's its value at? If it's a home, $500,000, $800,000, where is it physically located? Those are factors that are going to determine things like geographically, is it susceptible to more risk from natural disasters, from crime, all that sort of thing. It also will determine its access to fire services. And so if it is close to a 24/7 staffed fire station that can get to it within X number of minutes, then it's going to be rated under the protection class system. And so in Oregon, the protection class system goes from a PC1, which is like stellar, to PC10, which is the kiss of death. And so if you have a property that's got a PC rating of 1, 2, 3, up to 7, probably, carriers are going to be like, fine. You get into 8, 9s, and 10s, they're probably running away. Because if they've issued a policy for a property that's got an 8, 9, and a 10, and they get a notice that a fire is broken out, by the time somebody gets there to assist, there's a good chance that insurance company's just writing a check. And they don't like writing checks. So that's a big piece of the puzzle as well. Construction type is super important. Frame built homes, log built home. Is it a brick home? Is it a manufactured home? Manufactured homes narrow the potential pool of insurers to a small handful in the state of Oregon because they treat manufactured and mobile homes like very fast depreciating assets. And so you might be dealing with 3 or 4 that are willing to issue policies. And if it's more than 15 years old, it could be less than that. So my advice would be if you have a manufactured home that's currently insured and you're dealing with a rate increase, don't cancel it because they've made you mad. Shop and see what your options are. And be aggressive, ask lots of questions, but hang on to the coverage that you've got until you found a better solution. So that's super important there because there's not a lot of options right now. Homes age and condition, new homes in great condition, easy. Older homes in great condition, pretty easy. If you got a roof that's like a 3-tab architectural shingle roof that's 15, 20 years old, you're going to have a hard time. If you got a roof that's 25 or 30 years old, you're likely not going to get an insurance policy issued. And that's rough. So got to be mindful of that. And then your claim history going back 5 years. And it's not just on your current home. It could be on any home that you've had in the last 5 years. And think about every property that's in your name. So if you've got multiple homes or you have a vacation home, everything is subject to that consideration. And if you're looking to purchase a home, the home that you're looking at, that claim history is part of the mix too. All this stuff is looked at from an underwriting factor, and then your credit score is looked at. And then they look at all this stuff, they put it in the old algorithm and decide, how am I going to come up with a number? Each company kind of weighs these things differently. And lo and behold, they're either going to issue you a quote or they're not, and they're going to rate you. That's kind of how the system works. If you get a non-renewal notice or a renewal and the rate just kind of makes your heart stop, first thing you want to do is ask why. You want to ask for a detailed explanation. You have the right to ask that question, and you should. If you get a specific reason about like a non-renewal or a reason why something happened, you can ask about, well, if I mitigate that, if I fix this issue, can I get the policy reinstated? Like, if I fix the railing on the deck, or if I fix that roof? The reason why that's important is that it's likely going to come up if you go shopping with other carriers. So be aware, and if you can maintain your policy with the current carrier, that might be the path of least resistance. Doesn't mean you shouldn't shop, but you want to maintain coverage. Having gaps in coverage is really bad. Talk about discounts. I mean, there's ask about any discount you can get. There's no shame in saying, hey, was there a discount for my anything? I mean, a veterans discount, a bundling. I've got a security system. I mean, all these things are potential sources of discounts, but if you don't ask for it, you're not necessarily going to be offered it. The other one is to ask to be re-rated, because when policies are initially issued, they're rated based on all the scoring I talked about in the previous slide, but they aren't automatically re-rated. And if you ask to be re-rated and your score improves on an existing policy, well, then they have to apply that and your premium is going to come down. If you have an existing policy and your score goes down, it can't be applied to the existing policy. So it's a no harm if you're as a current policy holder to say, hey, re-rate me. When you go shopping and you go to a new carrier, they're going to run your numbers and pull the information, and the rate and the score is going to be what it is, because they're going to pull the information as for new. Look at your coverage levels. Make sure they match what you have, and make sure for certain that your dwelling limit is at or maybe a little bit above at least the replacement cost. You don't want to be at a point where you're underinsured. And if you need to make adjustments on the other stuff, like I've got way too much coverage on my personal property, or maybe I'm overinsured on other structures, you can ask to make adjustments there, but please don't be underinsured on your dwelling limit. It's a recipe for disaster. The other piece is to ask about deductible changes, because you can oftentimes make substantial changes in your premium cost by changing your deductible. Maybe your policy was issued at a $1,000 deductible, and if you go to a $2,500 deductible, your premium comes down by a couple $100 a year. Maybe you can afford or consider affording a $5,000 deductible. And again, I'm not trying to tell you how to spend your money, but asking for quotes at higher deductible levels may result in a substantial premium drop, or enough to where it's like, okay, I can accept that. So, quotes are free. So get the information and make a good decision. If you have been denied coverage in the standard market by 2 carriers or more, and you have other options. The other options are the non-admitted market, which is the surplus lines carriers. And so you can ask your agent to say, hey, get me a quote from the surplus lines market. And these are carriers that are willing to take on sort of higher risk stuff. And they can offer the same types of coverage. It's a little not riskier, but they do have the option of excluding some perils. And if you're in an extremely high risk area, like for wildfire, they might want to exclude something like wildfire coverage. So if you get a policy issued by a non-admitted carrier, you want to make sure you read that policy and understand exactly what's covered. If you're not getting a surplus lines or non-admitted policy, the last option in Oregon would be the Oregon Fair Plan. And it's intended to be the insurance of last resort in Oregon, so that people don't go without insurance. Again, this is similar to like the National Flood Insurance Program. It is a essential policy. It's not a great policy, but it's there as sort of the last ditch, which is going to give you basic property coverage and personal possessions, but it's going to be at ACV, which is not awesome. The dwelling limit is $600,000, and it does not have liability coverage as part of its standard option. The Oregon Fair Plan Association have a partnership with another carrier called Access 180 that does what's called a wraparound that can enhance that policy and add higher levels of coverage and replacement cost and even liability. But all those things cost additional money. So if you wanted to pursue that as an option, you can do that. It just ends up, how much money do you want to spend? What's nice about Oregon Fair Plan is that their underwriting guidelines are fairly lenient. And basically, one of the things they say is you got to be willing to do defensible space and home hardening, meaning you got to be able to put in some of that effort to protect your home against the risk. It's got to be a standing structure, and it has to have a roof. Not a roof that's 5 years old or 10 years old. It's just got to have a roof. And outside of that, are they going to consider things like claim history? Yeah, but they don't have nearly as high a bar to meet as the other carriers do. And it's not intended to be a long-term solution. It's intended to be short-term, a couple of years, and then hopefully people can get back into the standard market. If you're shopping for insurance, number one, make sure you're dealing with someone who's licensed, and you can do that through our website, dfr.oregon.gov. And then work with people that are helping you and listening to you. One of the best ways to get a good connection is to go on referrals from people that you know, who's a good agent, who's helping you. That's like with anything, a good mechanic, a good contractor, talk to your friends and do that. But there's great agents that are out there. I'm not telling you that there's the whole host of bad agents anywhere. Are there ones that don't do great work occasionally? Sure, but that's true of any industry. So, but find one that is you're having a good connection with, that understands what your needs are, and ask the questions and make sure you're getting the answers that you need. All right. If you're dealing with claims and payments, it can get messy, and we have an awesome guide about, it's certainly post-disaster claims guide that can walk you through that process. I would absolutely encourage you to check out that link that's going to be offered up to help you understand how that process works, especially if you've got a lender involved and you have 2 and 3 party checks and how to get those endorsed and payments processed and, your rights in that process. It can be a bit daunting, and, you as a policyholder, an Oregonian, have quite a bit of rights and protections in place that you want to be honored. And you can also reach out to our advocacy team at any point in that process and say, hey, I'm feeling like I'm a little confused here, and they can help you as well. The other piece to be thinking about is that when bad things happen, bad people come out of the woodwork and start offering themselves to say, hey, we're here to help, and they're really not. They're here to take your money. So trust your instincts. When people knock on your door and say they're here to help do debris cleanup and you didn't expect it, don't hand them money, please. Disaster scams are really prevalent. We have a great guy that kind of walks you through that as well as other scams, which are painfully prevalent. And if you ever feel like you need to contact DFR for any of our consumer advocates, for any of the reasons I talked about, they're there to help. Give them a call, send an email at any time. You're free to do that. A bunch of different links. I think more importantly, you're going to see the document links that come to you at the end of the chat or the session here, but you can check those out if you'd like. We are on social media, Facebook, Instagram, X, and all those other fun places, LinkedIn. That's that's our contact information. Insurance is dfr.insurancehelp@dcbs.oregon.gov. And for financial services, it's dfr.financialserviceshelp@dcbs.oregon.gov. And again, the primary website is dfr.oregon.gov. So I think that is it. And there's a survey if you want to do that, but I'll leave that up for now. And that's the end of me.
Thank you,
You
Matt. We are close to our time, and right now we're going to take a short break What time is it? Be back at 7:05.
All right.
Okay, well, we're going to get back here. I'm sorry, I can't get my video to work. There it goes. Thank you, Matt. Um, so the next 45 minutes or 40 minutes, we're going to have a panel and answer questions. Joining Matt are Chris Chambers and Brian Hendricks from Ashland Fire and Rescue, and Greg White, owner of Reinhold and O'Hara Insurance Brokerage and president of the Ashland Chamber of Commerce. They are also, they can ask questions of Matt as well, based on local insurance related experiences and share their own insights. If you'd like to address a question to any particular person on the panel, please indicate this in the Q&A box along with the question. So I'm going to kick this off with a question that goes back to the Spokane situation. Could an urban conflagration like Spokane is just experienced change insurers' assessment of wildfire risk in communities like Ashland, even for homeowners who have hardened their individual properties? And that question is directed at Matt.
Well, okay, so can it change for Ashland? I mean, specifically by Oregon statute, insurers' losses outside of the state, no, they can't. Let's say I'm picking a carrier like State Farm. State Farm can't say our losses in Spokane can now be taken and applied to Oregon policyholders. That's not allowed. But in a practical sense, I think this is important to understand. There's a big piece of property insurance that people probably don't understand, which is the reinsurance market. And so every single insurance company insures their portfolio of policies through reinsurance, global reinsurance, carriers like Lloyd's of London and others. And it's a big part of the premium that we all pay. 25 to 40+% of our premium could be associated with reinsurance. So when you think about the global impact of things that are happening, things like ships that are not traveling through the Strait of Hormuz and hurricanes and fires in Europe, and of course this horrible thing that happened in Spokane, the reinsurance market rates are going up. Well, reinsurance is a cost of business that affects all carriers, and I'm kind of simplifying it. So in a roundabout way, it does affect all of us. But they don't get to directly take those impacts and say, yeah, we're going to apply that and say, yes, Ashland, you're now hurt by what happened in Spokane. But it affects us all. It eventually comes back to us all. Sorry.
Okay. And then on, this is a question from the audience. How do we assess if we have enough fire coverage? And if we inquire with our insurance company, does it send a red flag?
No, I don't think it sends a red flag at all. I think it fundamentally, you want to make sure that it's not really fire coverage, it's dwelling limit coverage. You want to make sure that your replacement limit and your dwelling limit are aligned to be at the same amount, or your limit coverage is a little bit higher. So again, if your home was assessed as part of your intake by your carrier, they said, oh, your replacement limit is $500,000 and your coverage should be at $500,000. That's great. But if your policy was issued 20 years ago and you really haven't reassessed that, I mean, it adjusts automatically each year, but they tend to get a little out of sync over time. So it's not bad to go back and take another look at it. You can look at it from a cost per square foot standpoint. I mean, I'm not saying that Google is the answer, but it's not bad to say what is like the cost per square foot to build a X quality home in my area, and it's going to spit out an answer. It might be $485 a square foot. It might be $600 a square foot. And if you start doing the math, and you go, wait a second, my 2,000 square foot home, based on that number, that doesn't jive with my coverage limit. And that's just sort of a spitball type thing to come up. But if it's real close, that's fine. And then typically, if you're asking for a higher limit that's $15,000, $20,000 above where you're currently at, your insurance company's not going to gripe with you. But if you come back and say, I want a $200,000 higher limit, you're going to have to prove it. You're going to have to come back with some clear justification. And that's when you might need to get either your own appraisal or maybe just a contractor to say, hey, what's a reasonable amount? And that might be a less costly way to go about it.
And in the wildfire world, a catastrophic conflagration burning many homes in an area at the same time, the rebuild rates are much higher. Could you speak to that?
Well, yeah, I mean, it becomes a sort of a supply and demand issue, and that becomes like, material costs spike. I mean, unfortunately, it's sort of, people take advantage and then labor costs go up. But if that occurs, that's where that extended replacement cost is important. And then other regulations come in and say, no, you can't abuse people. But it's not uncommon to see like a sheet of plywood all of a sudden goes up in cost. Well, that or a 2x6. So widespread disasters are going to make the cost of materials and labor and transportation, it's more expensive. So having that protection, in particular of extended replacement cost, is, in my opinion, a good idea. I'm not trying to tell people how to spend their money, but be mindful that you could be at a significant disadvantage if you lose your home in a disaster and a bunch of other homes in your area are brought down at the same time. You are likely or have a potential to be underinsured.
Hillary or Lori, do you want to pose a question from the Q&A?
Yeah, yeah, I've got a couple. Thanks, Charisse. So here's a question. I've got two back to back here. So Matt, I think this is for you. In the situation, say, where Ashland is, the community has done its job and it's like really done a lot of home hardening. Would an insurance company take that into an account for a community on the whole?
Yes and no. I mean, and I think the more a community is engaged, it is a plus. The challenge right now is that there is not a universally applied standard in Oregon, and it would be nice if there was, and that everybody is working off the same scorecard. But some carriers look at, and I'll give you my example. I have a home at Black Butte, and homes are kind of stacked on top of each other, and lots are right next to each other. And if you look at the standard defensible space, they want you to go out 100 feet. Well, I can't go out 100 feet because I don't own out 100 feet. That belongs to other people. So I'm reliant upon the community to do their part. And so when the community does their part and does defensible space and home hardening, it actually allows me to secure insurance. But I, as a homeowner, am only allowed to work within the confines of my property lines. And so, yeah, it's a little blurry, and it's a little frustrating when the statewide home hardening and defensible space standards got shelved. Now it's a little very opinionated response here, but it's a little bit of the Wild West because carriers get to kind of apply their own standards right now.
Mm-hmm.
I could
Yeah.
jump in a little bit on that one, Charisse, and add something to it. And the only thing that we have that gets towards a uniform standard at the moment that the industry is recognizing is the Wildfire Prepared Home Program, which has been sponsored by both the city of Ashland and the state of Oregon. It is linked to the IBHS, what Matt talked about earlier in the presentation, Institute for Business and Home Safety. They came up with standards. They are actually funded through the insurance industry, though they are firewalled from the industry. They do all kinds of research on all kinds of hazards. They're really amazing people. And they came up with a set of standards for wildfire that's based on best practices and the science that they are part of which is going to wildfires and looking at the damages and trying to ascertain what worked and what didn't. I know they were at the the LA fires this last year and filed a whole report on that. But if you want to look up the Wildfire Prepared Home program, you can Google that. Or there's also Wildfire Prepared Neighborhood, which is the next level up. If you are maybe particularly in an HOA or somewhere that's under kind of common governance, the neighborhood standard is really admirable. Some of those standards are hard to achieve, admittedly, but nonetheless, they are what works. And so I just pitched those if folks want to look into wildfire prepared home and neighborhood.
And then my question to Matt is, Oregon's support for the IBHS home certification program making a measurable difference in the insurability landscape?
Absolutely. It certainly would, because if we got to a standard level of certification and recognition across the industry, then homeowners could say, hey, I've achieved wildfire prepared or wildfire prepared plus. I've got my certificate. I can now be issued a policy. Now, is it going to cost me a kidney? Maybe. I mean, that's the challenge. I mean, I don't want to be flippant and say if you live in a high risk area, it's still going to be expensive, but you're going to have access to insurance. But yeah, I think it would definitely help move the needle.
One thing that rarely gets covered is having insurance during the evacuation period. Does the standard policy cover that for homeowners? And then the extended question would be, what kind of insurance should renters have so that they can protect their belongings and survive during an extended evacuation?
Sure. So an evacuation, so if you are under a mandated evacuation and you have almost every policy issued, homeowners or renters is going to have additional living expenses, and that would cover you for those additional expenses if you want to make the claim. And so I will kind of make that caveat as which, any claim you make has an effect on your claim history. So keep that in mind. But an evacuation is a qualifying event for additional living expenses. Now, if you're evacuated for a day, should you make a claim? That's a judgment call. If you're evacuated for 6 weeks, yeah, where else are you going to live? You absolutely should do that. And each policy, again, is going to have a specified dollar amount on there. A renter's policy is probably going to have a pretty small amount. It might be $20,000. A homeowner's policy could have a pretty hefty amount on there. It might be $120,000 or $150,000 for ALE on there, which can be life altering. If your home is burnt to the ground and you have nowhere else to live, that's going to give you cover for 8 months or a year.
Hillary, do you want to offer another?
Yeah, so we've heard stories about, and I don't know what's true and what's not true, but we've heard stories, for example, of insurance companies just leaving California, for example. What's the reality of that here where we live?
That's a great question. So Oregon has currently got about 103 insurers issuing property policies. So it's a pretty healthy market still. And the regulatory landscape between Oregon and California is quite a bit different. So we're a long ways away from what's happening in California. So it probably doesn't feel that way to folks that live in a higher risk area where policies are being non-renewed or rates are going up at a dramatic rate. So we're actually, it's still competitive. The industry still it's attractive to insurers. They want to be here and write policies. And I don't want to speak for the commissioner, but it's a fine balancing act of regulating the industry to maintain it being competitive and attractive versus over-regulating it and chasing them out. Because if it's over-regulated like it was in California, where they end up being non-profitable, they just cut bait and leave. And when that happens, it drives the cost up incredibly for consumers. So Oregon's trying to kind of be in a balancing position of maintaining a healthy competitive market and trying not to let rates go outrageously high. And I'm sure there's lots of criticism to say, oh, they're too high. Probably they are.
If a rental property is not covered by insurance because the landlord can't get insurance for their property, can the renter still get renter's insurance?
You should be able to get renter's insurance for your personal possessions, but that structure is not gonna be covered. Yeah. So but again, and you're not, as a renter, you're never insuring the structure itself. You're just insuring your stuff. But
Okay.
you should be able to get for your personal possessions and your liability.
And we have a fair mobile manufactured home population here. What strategy would you recommend that those homeowners use to have adequate coverage?
Well, first off, I want to be real candid with folks. Mobile home manufactured home policies, certainly for older ones, are almost always written at ACV, or actual cash value. And so you might have a mobile home that's insured at $150,000, but because it's 20 years old, if you have a loss, you're going to get a depreciated payout of an amount that's going to be frighteningly low, and it's going to make you so angry, because insurers look at manufactured mobile homes at horribly depreciated items like old cars. So be aware of what your coverage is. If you can get replacement costs on your manufactured home and you can afford it, it's better to have replacement costs on anything you insure, because it's going to be replaced. It's not going to be, here's an amount that we think it's worth. That's sort of the difference. Actual cash value is, oh, I paid $5,000 for that couch 10 years ago, but now it's worth $800. Well, I paid $5,000 for it, but it actually costs $6,200 to replace it. Here's your replacement you need for it. The replacement cost is significantly better insurance. It costs you more. If you can find that, get it. Just be mindful of it, of what you're paying for and what you're getting. um, at a certain point, it starts to feel like what you're paying for in manufactured home coverage is like, why am I spending this money? You're really spending it to protect your liability and your personal possessions, and then sometimes that dwelling limit ends up being sort of a diminishing return. But again, everybody has a different perspective on that, so you have to look at your situation individually and uniquely. So I don't want to say that universally, but ask lots of questions on what their coverage looks like, and ask the question of, what happens if my home was destroyed in a fire? How much would I actually get based on this policy? It's a very eye-opening and sometimes frightening answer.
Okay. Um, Hillary, do you have another question?
Yeah, Matt, I think there were at least three follow-ups, I think, to your question about standard insurance, and you had mentioned what's covered and what's not covered. And one of the things that's not covered is arson, and you were talking about if you burn your own home down, that you're out of luck.
Yeah.
However, if there's arson in your community, does that put your insurance at risk at all if your house is impacted by that?
No, 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 no. So, I mean, and again, I'm not an adjuster, so I don't want to speak for how those are going to be handled. But no, those cases would be covered by the insurance companies. If I mean, I'll say it this way: if an arsonist burnt their own home down and it took out a whole community, I'm going to make the leap that arsonist home would not be covered, but everybody else would be. There'd be a whole bunch of legalese and subrogation behind the scenes to try and get whatever funds they could out of the person responsible, which there's no way in God's green earth that they could ever cover that from the individual. But the insurance would, you're covered because the arson was not by you. It wasn't your intentional act. If you do an intentional act on your property, you should not expect to be receiving a claim payout. Just like if you take a hammer to your car and knock the windows out, you're not getting a claim paid. That's on you.
Okay. We're alternating between questions that I've been asked regularly and ones that are on the Q&A.
Sure.
So what are the three rating tools that are used most by all insurance companies? You mentioned this in the Ollie class.
Off the top of my head, I can't tell you, but I'm gonna bet you that Chris can probably tell us.
One of them
Um,
was a map because I shared the example of how I lost my insurance in just outside of Ashland. In fact, Greg White was the broker that tried to help me find new insurance, and all the insurance companies refused based on my address.
yeah. There's a bunch of different tools. There's like LexisNexis. There's Clue, which is a tool that allows for the claims that are seen across all carriers. They all get to see that. So the thing is that there's no secrets across the insurance industry. It isn't like, oh, I had an issue with this carrier. When I go shopping with the next one, they're not going to know about it. Yes, they are. Uh, the the robe is fully open, and the information that you and your experience you had with X carrier is seen by the whole industry. And so like that, those rating tools are, there's proprietary information that each carrier has based on their loss payouts, but there's rating tools that the industry all taps into. So it's a combination of all those things.
Okay.
Yeah.
Hillary?
Yeah, so I have a question here from Julie about kind of a follow-up when you were talking about roofing and what kind of roofing was like, yeah, you're out of luck first as regard to insurance and what was actually okay. And when you look at the difference between the number of years your roof is guaranteed, 20, 25 years, some are 40 years now. Are you looking at are insurance companies looking at the age of the roof, or are they looking at what the roof is made of?
Good question. So typical roofing is that architectural shingle asphalt roofing. So my comment was primarily around that. That's a standard roof. It's a Class A roofing material. It's fire resistant. It's great. If your home has got that material on it and it's under 15 years old, not a problem. If it's over 15 years old, a lot of insurers now look at that and go, it's starting to age out. It might have been installed when it was originally put on as a 50-year roof, meaning it's going to last 50 years. And it may, in fact, be perfectly functional for 50 years, but it's going to lose granulars. It's going to cosmetically look wrong, but it's not going to fail. The insurance companies, though, start to say, statistically, because it's getting older, there's a higher risk of it being a failure point, and we don't want to issue policies because if a roof fails, that means we're going to see water damage and we're going to write checks. So this becomes this challenge of, as a homeowner, if you got to go put a roof on and you're presented with the option of, well, do I put a 50-year roof on or do I put a 30-year roof on? And the difference in price can be substantial. I myself had to put a roof on my house this year for this exact reason. I have a 24-year-old roof that was perfectly functional, but there was no way I was getting my policy renewed until I replaced the roof. And I went down this path of, well, it's going to cost me almost 20 grand for a roof. And they were trying to sell me on a 50-year roof. And I said, I'm simply not going to spend that money because I know that in probably less than 20 years, I'm going to be doing this again. So that was my choice. Now, if you choose to go with a different material like metal, you're going to probably get 40 plus 50 years out of it. Tile, similar if you maintain it properly. Longer lifespan product is treated differently. But the common roofing material, which is asphalt shingles, they're getting a much tighter underwriting consideration than they used to.
Let me ask you kind of the opposite question then, Matt. So if I've been in a house for 20 years or something and I just put a new roof on it, well, is it possible I could get a deduction in my premium payment?
You would think so, but they also might then come back and say, hey, you just put $20,000 of value in your home, and so the replacement cost on your house just went up. It's so counterintuitive and
Mm,
frustrating.
mm.
It ensures that you have access to the policy, but probably made your policy go up because the cost of the replacement went up.
Great, thank you.
Yeah.
I want to give an opportunity to Brian or Chris to ask a question if you have any. No? Have you heard from residents or businesses that have insurance questions or issues that are common?
The big ones I get are usually related to their insurance company reaching out to them with a letter or statement requiring work to be done on their house, with not a lot of clarity as to what is needed. And so there's a lot of follow-up that the resident usually has to take with their either the representative, like their broker, or going further into the company, like you had to do with yours, just to find out exactly what it is they need to do. Because a lot of the assessments I'm doing related to that, what we would consider home hardening and defensible space that would be adequate to protect the home, insurance companies are typically requiring more, like that 0 to 5 fully non-combustible, where we might allow low-growing plants in rockscaping or something very small like that. They do not really want to do that, primarily because of national standards and best practices. They're just like,
You're cutting out, Brian.
sorry. Able to hear me all right?
Yeah.
Okay. So that's something I commonly face with residents having challenges working with their insurance companies, but I don't have a specific question. Matt's been covering a lot of these really well. So thank you, Matt.
You bet. Well, I think I'm going to comment on that. And the first thing I would say is that, policyholders that get that letter, the first thing I would say is like, hey, I would celebrate getting that letter because one is that the insurer they want to reissue that policy. They want to maintain the coverage. So it's like they still want to be in the game. They want to be coverage in the area, offer coverage in the area. So there's something to be somewhat celebratory about that. The fact that they haven't provided clear explanation, yeah, that's super frustrating. And that's where it does require some personal advocacy to be willing to kind of get in there and work and ask questions of your agent or your carrier. I would go back to this point of saying it's important to have an agent that you have a good relationship with, that is responsive and that's willing to answer your questions. I was lucky that our agent that we had for our property in Central Oregon was willing to take my relentless, like, oh, what the heck, because I knew what they wanted, but they just wouldn't detail it in the way that they needed to so that I could fulfill their requests. And then, how did you want it documented? Do you want photos uploaded? Do you want it this way? So you got to kind of jump through the hoops. And again, I think having a standard established for the state would be so much more helpful for people, because then it's like, hey, we're all working on the same playing field here, as opposed to, well, this is all state standard and this is State Farm standard and this is, what are you guys working Wildfire prepared? Are you doing Firewise Plus? Or who knows? It doesn't make any sense, and it feels kind of unfair right now.
What do you think about the legislative landscape to change that? Where do we stand? What's the status? Are we
I don't know for certain. I know that Senate Bill 85 is actively being pursued between OSFM and IBHS. I know that they are actively in working together, specifically around the wildfire prepared standard and how that can be adopted within the state. I just don't know how much progress is being made, so I don't want to speak out of turn too much.
Thank you.
But it's definitely being pursued.
Going back to it a little bit, one of the questions I had was, which mitigation actions have the greatest impact on keeping or obtaining insurance based on your experience?
The biggest ones are going to be trees right up against the house, branches over the roof line. because one of the first things that carriers are doing are using aerial imagery, and they're looking down at the house and they're going, what is it? And if they see that trees are over the roof, they're almost immediately going, nope. And they're going to kick it. And so if you got a big old branch that's laying over the top of your roof, you probably need to get that out. When I was an agent, I had policies rejected by AI underwriting based on shadows. And so they looked at it and they go, oh, that shadow is a tree. I'm like, no, it's not a tree. It's a shadow. But trees close to or over the roof line, and valleys full of debris, those things are like immediate. But those are also the things that are so impactful for protecting your home against embers. I mean, and so this is where defensible space and insurance, the two things really overlap. It's like, that makes so much sense. Do those basic defensible space things to protect your home and to improve your insurability.
Does that apply, Matt, to if you have a metal roof and you have a tree near your house that the branches might be over it? Does that impact it at all?
Yeah, the insurers are still going to squawk about it. So they do not like trees, primarily because they don't want a tree that's close to the home. So it still becomes a fire risk close to the structure. That the roof being metal is great, but it's because you've got that fuel source so close to the home.
Mm-hmm. I have a question here about replacement cost. Does replacement cost usually include demolition if demolition is needed?
Yeah, so demolition debris removal is almost always part of your total limit on your policy. And so again, I'll use the example. Maybe you got a $500,000 dwelling limit on your policy, and your debris removal, which is that whole thing, would go against that. So if you have a crazy high amount of debris removal, let's say you spend $120,000 in debris removal, it reduces your dwelling limit down to $380,000, which is left to rebuild your home. Again, something to consider why it's that much more important to look at the extended replacement cost. This was a point of concern this past year in the Rowena fire up in the Dalles, because debris removal was a massive expense for that community. And it went back and forth about who was covering it. And then ultimately the state picked up most, if not all, of that expense. But had it not come in and done that, the debris removal would have annihilated the cost of or the coverage for most of those homeowners, because many of them are manufactured home and mobile homes. And it was a toxic wasteland for the most part. So it became an extremely expensive debris removal and cleanup. So I would, again, it's covered, but it debits against your dwelling limit from a rebuild standpoint.
I have a question related to SB 83, and I'm not sure it's valid as a question, but
all questions are valid. Come on.
when you talk to the SB 83 retroactively eliminating standards, I became confused about whether that would affect Ashland building and landscaping codes and ordinances that had been established.
No. What it repealed was the statewide. That was to say, hey, these are going to be applied as a standard across the state for everybody. What it did is it pulled them off from the statewide and shelved them to say, hey, they're available for local municipalities to then apply them. And so, like, Sisters has done that. Parts of Bend have applied some of the building codes and defensible space codes, and Ashland has done some things. So it pushed it back to the local communities to enforce and adopt them. Which then creates this mismatch of like, well, okay, Sisters has got a really high level of home hardening and defensible space, but LeGrand doesn't. And so if you're an insurer who is insuring properties in those areas and they know that they've got a high level of adoption for home hardening in one area and next to nothing in another, it's like, what are they doing?
Yeah.
It makes it it's very confusing for that inconsistent application of home hardening requirements.
So that kind of frightens the insurers away from Oregon.
It it
It
does
could.
make them makes them take pause
Yeah. Okay.
about how much risk they're going to take on.
Um, Hillary, do you have another one?
Yeah, I do. Actually, this is a great question about AI's role in assessing the assessments that insurers might send to customers, and just in general. Are you seeing that AI is being utilized in many ways with regard to insurance companies covering homes?
Sure. I mean, I think technology is absolutely being applied to be more efficient. I mean, I talked about how it's being used for aerial imagery and initial assessment of properties. I think it's certainly done as part of the some initial claim handling, but there's always a human element that is brought in at some point in that process. And so I think it's important that consumers remain engaged and understand that, if you're when you're dealing with an insurance agent and carrier, there is the opportunity. Hopefully, you always have the opportunity to deal with a individual. If you go and choose a online only solution, um, you may in fact be dealing with a much more technology driven solution than with someone where you're able to call a local representative. So again, I'm not telling you that it's a bad choice, but um, there's a higher likelihood of more AI usage in some of those lesser known carriers.
Thank you for that. Here's a question about, I'll just read Candace's question. Jordan Thomas talks about his book, When It All Burns Down, about a thirsty environment. Long periods of low humidity creates atmospheric thirst. Does insurance take this into account? Does our premiums increase in long periods of low or no precipitation?
Great question.
Yeah.
I, I don't really have the data to answer that question directly. So I don't want to misstate that one.
Great, thanks. I actually
Yeah.
think that over here on my end with the chat, we've in the background covered a lot of questions about home hardening, and we've covered almost all of the main questions that directly pertain to insurance. So, Charisse, if you have any kind of one or two questions left, I will defer back to you.
Well, we are at time, so what I suggest, Brian, I think, has answered a couple of those questions, is that we will offer our services to answer questions in writing and post them as part of the attachments to the event documentation. So please set those aside and Brian and I will get to them. I'm volunteering Brian. Sorry about that, Brian. And I appreciate everybody's time and attention. I'm going to give it back to Lori. I am sorry that Greg White was not able to get on as one of the panelists. I would have loved to have heard from him. If Greg, if you have the time and interest to share a story or perspectives in the follow-up written response to this webinar, we'd love to hear your insights based on experience.
Yes. Well, thank you. This was an excellent program. And now I've got my slides. So I'm just going to do a couple little thank yous here before we close down. The best things in this town are about partnerships, and we're really grateful for all the organizations that have come together to make this happen. Ashland.news, the City of Ashland, of course, Ashland Climate Collaborative, Ashland Chamber of Commerce, and the Rogue Valley Metaphysical Library. So everybody kind of pulling together allows us to do great work, and it's a lot of fun, a lot of talent. So what we've been saying with all our wildfire programs is great that you have been able to participate, and but we're better prepared together, right? This is about being better together, just like over Brian's head. Yeah, there he is. So I think, a lot of movement is happening right now around getting our neighborhoods organized, to know each other's contact information, to share information about how to get on alerts and what a red flag warning means, just like really talking about it and supporting each other. We're not all alone in this. We're all together in creating these solutions. So I want to thank Matt for coming in from a distance, from his office, I'm sure he's at his home. And Charisse, for your leadership in making this happen. And Chris and Brian, for your excellent work all the time for the city and for your great partnership. Hillary, for doing a great job with the questions. And I will be sending you a little feedback survey so you can give us feedback. Let us know what else would be helpful to you. And we will be sending out, this was recorded, we'll send out the link to the recording, and we will give you any of the phone numbers and information that was shared here this evening. We'll make sure to put that in the email as well. So you have it. So don't worry about it. We got it. Better together. Thanks, everybody. Look at that. 2 minutes late, but that was my fault. It's a great job. Thank you. Thanks, Matt, Brian, Chris, Charisse, Hillary. Bye.
Bye. Thank you.
Thank you.